So what was previously considered difficult to electronify is now highly electronified. So if you take, for example, your government bond market, which is now about 80% electronic. So what we deem to be illiquid now, or not very electronified now, will look quite different in a few years' time.
And how does it work with the kind of Pareto's law of 80-20? What's the kind of split of business and what's the split of effort?
The effort to book that electronic trade should be relatively small so that it frees up our traders and our salespeople and the buy side to focus on that 20% that requires a lot more effort, but needs the effort, it needs the human being behind it. That's where the value add is.
Do you ever have any pushback from kind of people on a sales desk around technology?
These days, I think electronic is very much here to stay, and it's been seen across all the other asset classes where sales and trading that adopt the electronic mindset are the ones that are often the most successful.
This is Matthew Chung. I am CEO of ipushpull, and today we're welcoming Deniz Mace-Jones from UBS. She is the Global Head of Rates and Credit Products and Electronic Distribution at UBS. So Deniz, thank you for joining us on the Capital Markets FinTech Forum.
Hi, thank you for inviting me. Happy to be here.
So we wanted to talk today about the state of play in fixed income electronification, and then what's kind of happening in the markets, what's happening around workflow, what's happening around technology, and how we think those things are going to change as we go forward. So I think to kind of set the scene, is it worth us talking first about liquid markets versus illiquid markets and where electronification kind of sits on that?
I think it's probably a good place to start. So I've been doing this now for enough years to have seen some of those markets evolve. So what was previously considered difficult to electronify is now highly electronified. So if you take, for example, your government bond market, which is now about 80% electronic, maybe more, depending on which stats you look at. If you look back to sort of 2010 or 2012, it was more like 30 to 40%. So what we deem to be illiquid now, or not very electronified now, will look quite different in a few years' time. But what we've seen in terms of that evolution is there are obvious pockets that can be automated or electronified, and we've seen a massive increase in that, especially in the last sort of 5 years. So if we look at things where you look at liquid markets, you'll see a lot of automation. So the use of automatic dealer selection, that's really burgeoned in the last few years, but there are still markets where that is not the case at all. So an example might be cross-currency swaps, for example, is not highly electronic yet. Rates options, not highly electronic yet, but they're starting to get there as well. So we see quite a big difference. It's far more manual on those more illiquid markets.
Why do you think it's happened in the last 5 years?
Good question. So some of the things that has driven that actually has been, I'd say it's 2 to 3-fold. One of them is regulation. So the regulatory landscape has actually changed the market structure. We're seeing a lot more markets moving towards on-venue. So for example, with Dodd-Frank and MiFID II, back when those two bits of legislation came out, we saw a huge increase in electronification of interest rate swaps, as an example. So the regulatory landscape can change the market structure itself. And just some of it is more organic. So for example, clients are finding that they've tested out some technology, maybe it's worked, they've tweaked it a bit, and it's been a bit more organic in terms of its growth. And so you'll see more adoption of that electronification. And also the platforms are the ones doing some of the innovation here as well. So there's been lots of new trading protocols that have come about that have really changed the market structure and how clients want to trade. So in the credit world, for example, portfolio trading was nowhere a few years ago, and now it makes up quite a large percentage of the flows that we're seeing on the platforms that do provide portfolio trading.
So just looking at those two areas of rates and credit, like you mentioned about portfolio trading and credit, you mentioned about interest rate swaps and how that's become more electronified. If we take each individually for rates and credit, is there certain instruments and asset classes on that spectrum which some are very electronic, like some of the kind of cash bond trading, versus something that's very manual and OTC driven for rates and then for credit?
Yeah, so if we focus on rates to begin with, what in rates is very liquid is obvious things like Euro government bonds. If you take Italian government bonds, in EGBs, 80, maybe even 90% of that is electronified. It's extremely liquid. Whereas if you look towards, for example, high yield or IG on the credit side, it's still maybe 20, 25, 30%. And within that as well, you'll see bonds that trade very often and so would be deemed quite liquid, and then others that trade maybe once every month, 2 months. And so the workflows are quite different between those. In interest rate swaps as well, different currencies have different adoption levels and different levels of liquidity. So if you look at G3 currencies in interest rate swaps, for example, you'll see far, far more liquidity providers, and you'll see global price making, for example. So dollar swaps, for example, you will find prices following the sun, whereas for other currencies, EM, IRS currencies, OIS, etc., it is far less liquid, and so the workflows are more manual.
And what does that look like on the credit side?
So on the credit side, let's say, for example, a client wants to trade, and I'll speak from the perspective of the sell side. The inquiry can come through chat, or less so over the phone these days, but the phone still rings occasionally. It will come through normally through the chat, and a salesperson will pick that up. Then they will call over to the and it's usually on chat as well internally, but they might call over to the trader and get a price. It's all quite manual. So it could be a copy paste job. There's a lot of copy and pasting still going on in the OTC markets. So it could be a copy and paste of the inquiry into an internal chat where the internal trader will provide a price, and then that gets copy and pasted back into the external chat with the client. And then it needs to be booked into the booking system. When I first started out, there were paper blotters. Thank goodness we're not using those anymore. But if you walk across the trading floor of any bank, or indeed buy side, you'll see scraps of post-it notes and papers with trades written on them, which is not ideal given it's 2025.
So how much has that changed in your career in sales and trading?
Massively. If I cast my mind back to the first time I stepped on a trading floor when I was in my 20s, everybody had those A4, including myself, A4 printed blotters. And then at the end of the day, I would type that printed blotter up into Excel. And I was one of the few that did, or I was giving everyone else to type up as well. That was fun. Deciphering everyone else's handwriting is not a forte of mine. So there were paper blotters. There's a lot more calling over to get prices. We still use the chat, obviously. It wasn't that quite that long ago. But it has changed hugely. And it depends on the product as well. So FX is obviously far more electronified. It's like sort of 10, 20 years ahead. It was way more electronified there. So when I first started out, I was working at Bloomberg and talking about internal RFQs for the FX flow, for example, which is only what's being discussed now in the fixed income markets. And by internal RFQ, I mean sort of the salesperson receives the inquiry from the client, and then the salesperson would then launch an internal RFQ to their own trader to get the price. That happened a long time in FX. That's been around for forever, and in fact, it's evolved way beyond that. In OTC fixed income markets, that's sort of what we're trying to do now, but probably more with an AI hat on it, because times have changed. So we've seen that massive evolution. I've seen that massive evolution. I've done e-sales for long enough that when I first started out, I would go to heads of trading and say, hey, you can just these small tickets, you can just click on the screen and just do it there. Safe to say there were a few raised eyebrows and the message didn't always land. But those same desk heads are now so engaged, looking at stats, looking at data, looking at hit rates, looking at no quote rates, slippage, things that wouldn't have been on the radar before. So for sure, it has come an awful long way in the last 15, 20 years.
And how does it work with the kind of Pareto's law of 80-20 with the amount of effort required to be booking trades and so on in trading on a venue somewhere versus doing it OTC? So what's the kind of split of business and what's the split of effort?
I think it depends, right? So we have a lot of clients that will say, this is generally well known in the market, where clients will say, if you're great, your performance is good electronically, the chances of us then making sure that the voice flow is directed is better, right? So the effort to book that electronic trade should be relatively small, so that it frees up our traders and our salespeople and the buy side to focus on that 20% that requires a lot more effort, but needs the effort. It needs the human being behind it. It needs the human in the loop, if you will, to make sure that there is That's where the value add is. It's not in making sure that I have accurately booked a tiny trade. And like, casting my mind back to when I used to have that paper blotter, I remember going home and replaying every single trade in my head and going, but did I book it correctly? Did I book it correctly? That was where 80% of my effort went, was to making sure I never got one of those wrong. Now that should no longer even be in our psyche of a salesperson. That effort should be going towards the value add because activities that actually bring in content to the client, or market color, that kind of value add business.
And that's a good point. In the world of AI and agents and technology rapidly evolving, that the areas where human judgment or human oversight is essential is very much in those areas that you mentioned. Talking to clients, understanding like their needs, what might be happening in the market, and talking to them about strategies and structures and so on.
Yeah, absolutely. And I think that's where we want to make sure that we are always asking ourselves, where are we applying ourselves to get the most out of what we're doing? Where can we deliver the most to the client to make sure that we are bringing to them what they need, rather than spending our effort or burning our calories on BAU things that don't actually add much value? That's where automation, that's where electronification actually brings huge amounts of value.
Do you ever have any pushback from kind of people on a sales desk around technology?
No, I think actually, especially these days, I think electronic is very much here to stay, and it's been seen across all the other asset classes where sales and trading that adopt the electronic mindset are the ones that are often the most successful. I've never had more incomings in my career than I do now from sales and trading saying, I just want to check this. I want to check, did we do the right workflow here? Could we have improved it? What could we do better? How is our performance with this particular product? These questions are incoming rather than me pushing it out to people. People are super engaged. They want to know about it, which is amazing. And I think the most successful sales desks and trading desks are the ones that are the most illiterate.
And presumably, at least on the OTC side, all this information and communication is 90% on chat, probably Bloomberg chat, presumably, if it's fixed income and credit.
Yeah, there are other chat rooms as well that sometimes they come in on, but the vast majority of it does come through chat. Yeah.
So there's a lot of valuable data that's in those chat rooms, which isn't necessarily being used unless you're able to plug into it very easily.
Yeah, I think that's the next frontier that everyone is looking at, to say, how can we take unstructured data that is the conversation in a chat room, for example, and make the most of that, because it's very rich in information, it's super rich in data. What insights can we derive, and what knowledge can we take, for example, from that those chat rooms, and do something useful with it, whether it's creating content or delivering access, or it has lots of applications. But I think that's the next frontier that is in everyone's minds around what we can do next.
There's a lot of things that can help with immediately, with short-term pain problems and efficiency and so on. What would be the nirvana state in, once all that's all set up and running in 2 or 3 years' time? Do you see new use cases which you're not able to do at the moment, for example?
Yeah, always. There's so many things that you can do once you kind of open the doorway a tiny bit. All of the ideas come flooding of what else we could do with that data or that capability. But I think it's important to keep in our minds that we don't have infinite resources. Nobody does. And so we need to step into that process in a logical order to make sure whatever we're doing now builds in order to be able to pave the way for what we would want to be able to achieve in the future. So be that making sure that the data is well structured, saving down any data that we already have, making sure it's saved down in an accurate, correct way. And then also around the pipelines and just the plumbing itself, right? Make sure that the infrastructure is future-proofed in order to be able to cope with where we believe the market structure is going, which is more and more electronic. So I think it's really important to make sure that those things are in place in order to build upon it. I've seen all too often examples in the wider world where people have tried to build the spaceships, but they forgot the engine. So it can be super shiny, but it has to sit on very, very good infrastructure in order for it to last and be future-proofed.
I think that segues quite nicely into my next question around how do you see the kind of startup ecosystem helping to enable that as well? Because historically, I mean, when I started in the city like 25 years ago, every single bank will be building things in-house, whereas that is slowly shifting, where it's not 100% building in-house. There's still a lot that is, because there's a lot of IP and technology that you want to control, but there's other areas where other companies may have, external companies may have better domain expertise in building and enabling some of these ideas. What's the view kind of generally from your perspective?
So I think this applies to any industry. This isn't just banking and finance or markets. If you look at any industry, there will always be bits of your business that you would want to have your own IP. And then there are parts of your business that you would probably want to use someone else's expertise on it. Take the example of, for example, a builder. A builder is not going to also build all of his tools. Like, they will probably go and buy a drill and they will buy a chainsaw and they will buy a circular saw. They're not going to design and build all that themselves, right? So those utilities or those bits of infrastructure that are more or rather less to do with that institution's IP, then yeah, I think that makes sense. And I think also it's important to look at it from the point of view of case by case and working out, based on what our parameters are, and for each company and each firm it will be different, but based on the current parameters and where we want to be in the future, what is the right decision to make in that buy versus build discussion happens with that framework around it.
When you are deciding to buy or build something, there's obviously demand for some technology, either internally by yourself maybe, or it might be a client kind of asking for something as well. What generally pushes that innovation? Or is it a mix of both? Is it the clients on the buy side and your counterparts, or is it you looking to stay ahead of everyone else on the street?
Yeah, I mean, UBS, we pride ourselves on being client centric. So we would the loudest voices invariably and should be the client and what the client needs and what the client wants are. We try and stay really close to our clients to try and understand what those needs and what their vision is for where they want to get to as well, so that we can partner with them on any of those projects. Of course, the client demand is primary. If we're more inward looking, of course, our technology as well, we have to have our own technology plan to make sure that we are going to future proof our platform and our infrastructure. But I think, again, that would be informed by what the client demands are and where we want to be strategically for the future.
And talking about the future, to finish up, let's talk about AI. Obviously, we need to. It's 2025.
Can't not.
A lot of companies are trying to reposition themselves as AI first. Like a few years ago, it might have been cloud first or API first. Everyone's done those things. Now people are looking at AI first. How have you seen this AI first mindset trickle down into your realms of sales and trading?
Yeah, I mean, it's really interesting. It's one of those kind of exploratory bits of technology that of course, it's front and center for lots of people, but I think there's also a slight not a habit, but a desire to kind of hop on the bandwagon. I think we have lots of applications that we're exploring at the moment, and we want to make sure that we're exploring them and applying them in the places where they make the most sense. So just because you can doesn't mean you necessarily should, because maybe actually we could put our efforts into something that would have better impact or a better delivery for our clients, for example. So we're working through that whole AI process. It's really interesting. We're testing out lots of new kit internally, doing feedback sessions. So we have working groups around all of this, both internal and external. And it's been a really interesting process to go through. I'm learning a lot because I'm not going to sit here and pretend that I'm an AI expert, but working on it. And I think the applications within specifically sales and trading, it might be around, for example, looking at using a chatbot to inquire into tables of data. So at the moment, instead of someone's had their trawling through lines and lines of a table to look for trends in data, AI is extremely quick at saying, okay, we're at this point, I need to get a bit of information. Here's a giant table of data, extract the bit that I need. AI is much faster at that. So we can equip and arm sales and trading with data at their fingertips in a really quick way. And that kind of application is super interesting. And I know the buy side are doing similar sorts of things as well.
So to finish off there, in terms of AI and electronification, so there's a lot of tools that can be used in the kind of next year or two around automating the grunt work, which is what technology is essentially there to do, and
Yep.
help people focus on higher value tasks. If there's focusing on like high touch sales, for example, that's a good time that you've managed to free up to do to make your service better. On the electronification front, as these tools start to use, do you see a point in the future where every market is essentially electronified? It may be on a venue, or it might actually be electronified via the chat and the kind of tools around it. Do you see any markets that might not be electronified, or is everything heading in that way?
I think it depends on your definition of electronified. Is it the same as digitized? Because there's a slight distinction between the two. So if it's on a chat, then it's been digitized, but it's still two human beings still discussing with each other something about the market or a trade, for example. So I think every market is probably digitized. Is it electronified such that it's trading on an e-trading platform? This is a whole evolution. I'll bring back to that kind of example that I said to you before. When I first started out, the interest rate swap market was not electronified, and now 70 to 80% of it is traded electronically. So yeah, I think it is an evolution. At what point of that percentage scale it lands on, who knows? But I think most major markets, one way or another, will benefit from some form of electronification. That's not to say it lends itself to everything. So take, for example, structured products, because they are so bespoke, because they are so customized. Creating an electronic market for that would be difficult. That's why it's not very electrified already. Whereas the things that are far more homogenous, like for example, I mean, broadly speaking, a bond is a bond is a bond, right? Has an ISIN and you can buy and sell it. Whereas a structured product is far more complicated. That was the example that was given actually for interest rate swaps, saying interest rate swaps are far more complicated than bonds, so you can't electronify them. Yeah, here we are. Partly because regulation has driven them to become a bit more standardized. The evolution of things like IMM dated swaps and MAC swaps, etc., has driven some standardization, which has helped to therefore electronify. But generally speaking, less standardized products are slower to electronify, but doesn't mean that they will never electronify. It's just what form that will take is up for debate.
Well, thank you very much for sharing all your thoughts. If any of the listeners want to get in touch with you, what's the best way to reach out?
Best way to reach out is I'm on Bloomberg. You can reach me there, or via my UBS email address.
Thank you very much.
Thank you. Thank you very much. It was a really interesting conversation.